seeing asset prices that are pricing in, continued growth when we might have a meaningful contraction. That gap between, those two things, like if it's 50, it's 40 or 50%, 40%, like, that's a heck of an impact on asset prices relative to the current price levels. And that's not, that wouldn't be altogether that unusual. Like often in a recession environment, you get earnings that compress 25%, and you get, PEs that can fall 25 or 30% as risk aversion emerges. And that's how you get 50% declines in stocks. And to be clear, 50% decline in stocks, while it sounds, like an extraordinary event, and certainly would be a surprise to many people, 50% declines in stocks happen.
On this episode of What the Finance podcast, I have the pleasure of welcoming back Bob Elliott, who's co-founder, CEO, and CIO of Unlimited Funds. So, Bob, thanks so much for coming on the podcast today.
Yeah, thanks so much for having me. Exciting times to get together.
Yeah, definitely. I think we talked close to a year ago, which is crazy to think
Wow,
so much.
that's incredible.
Yeah, maybe 10 months. So much has happened since then. So yeah, I guess from your perspective, what are you currently seeing in the economy and the markets, and what's sort of on your radar at the moment?
Well, so much has happened. And at the same time, if we really think about it, like at least in the US economy, nothing's happened, right? Like the unemployment rate today is the same as it was, 10 months or a year ago. Labor market conditions are plodding along. GDP is still growing a bit above potential. Like, interestingly enough, basically, we are, inflation is moderated, although we already had seen that it was on a path to moderate to some extent given the fall in oil prices. And so in a lot of ways, we're kind of where we were a year ago, in terms of the sort of current picture of the economy. I think the thing that is meaningfully different, or I should say evolved since that point, is that we're starting to see increasing cracks emerge in the economy. And so in a lot of ways, like just as everyone that had thought there was going to be a recession in early 2023 has sort of given up on it, just as that's happened, I think in a lot of ways, we're starting to see some of the issues emerge that may be leading towards the recession in the next, say, six-ish months into early 2024. So I think that's kind of the interesting thing, is probably when we get together 6 months from now or 9 months from now, we won't say the same thing, that everything is kind of the same, right? Things will probably be pretty different.
That's interesting. So I guess what are the cracks that you're currently seeing? Because a lot of people have, or yeah, as you said, have shifted and said, oh, maybe the Fed will do it, maybe they'll land the plane. Everything's held up so far, so why would it change? But yeah, what are you seeing in that regard?
Yeah, and I think it starts with connecting how the Fed tightening, how you expect the Fed tightening to flow through. We've had a meaningful rise in interest rates. That is now, leading to elevated mortgage rates, elevated costs for businesses to borrow, et cetera. And so that's now flowing through. There's a, credit extension in the economy has slowed meaningfully, particularly for businesses. And that, that actually wasn't really related to SVB. SVB was kind of a red herring in that whole process, but it has slowed as costs have risen. You're starting to see, the elevated mortgage costs. We had an initial sort of blow off top when tightening happened, and then a bit of a rebound. But now those elevated mortgage costs, they just keep weighing on sentiment and activity in the housing market. We're seeing some slowing in production sectors of the economy. And then really, I think part of what we're seeing also, which I think most of the time people don't really think of the rest of the world's impact on the US when you're thinking about what's going to happen, driving us or dragging us into recession. But, the rest of the world does in fact matter. And the fact that Europe and the UK are continuing to soften pretty meaningfully, and China isn't getting the job done stimulating their economy, you sort of put all those things together, and you're starting to see the sorts of things that would typically align with a recessionary, the start of a recessionary environment. I think the main things that we haven't gotten to yet, and that's the real sort of the final spark on the kindling, so to speak, is a meaningful asset price decline. And that's going to have to come through or caused by, to some extent, the weaker data than people expect, but also by the continued pressure of elevated interest rates in the economy. And so we haven't quite gotten that yet. But, once that spark hits, the kindling that I just talked about, things can move pretty fast in an economy when you get that reinforcing downward dynamic that's going on.
Yeah, so many points to touch on there. I know you sort of mentioned something as well about how rather than the Fed maybe tightening, markets actually starting to tighten as well. So I'm not sure if, it sort of seems like you touched on a few points there, but maybe you can expand on that. It seems quite interrelated.
Yeah, I mean, the Fed, in a lot of ways, the Fed is decided to take a back seat here in the sense of they've tightened, they sort of look at the picture and they've tightened 500 basis points. And, they started quantitative tightening, but, and that's sort of plodding along and not much changed. But, they're not really looking to do a meaningful amount more. Instead, probably what they're looking to do is to be sort of higher for longer in the form of sort of pausing for longer rather than aggressively tightening. And the thing that's interesting about that is, I mean, first of all, that still will put some pressure on rates because cuts are priced into the U.S. 4 cuts are priced into 2024. So even if the Fed is flat in terms of their policy, that's an effective tightening. Each day they don't ease is an effective tightening. But I think the other thing that it creates is it means that you're going to have a long end tightening, right? Both because the Fed isn't doing the job that they need to do. Also, there's a number of supply dynamics that are also going to hit the long end over the course of the next 3 or 6 months. And so you put that together, and we're probably going to have what I describe as a market-based tightening more than a Fed-based tightening that creates the toppling of the economy. And that's not that unusual. Like sometimes there can be market-based tightenings that basically get it done. Of course, it's not totally irrelevant. The Fed's actions are not totally irrelevant because the Fed did tighten, 500 plus basis points, right? So it is a contributor to it, even though it's not the sort of the last push that pushes the economy over.
Yeah, and I think I talked to Andy Constant recently, and he was saying that there's been quite a shortage in sort of some of those long end bonds, which probably is now going to end. So now there's more supplies. Probably the prices are going to have to go down, and that's really been preventing maybe that tightening in some certain assets because there's been that shortage.
Right, and that's essentially the market-based tightening, which is because it's not the Fed. The Fed is not tightening interest rates. The Fed is not selling selling more bonds. They're selling some bonds right now, but really it's the fact it's the market for borrowing and lending in the economy that is going to require higher interest rates than what we've seen previously. And anytime you see that sort of dynamic, higher interest rates, it both has a very mechanical impact in the sense of if the discount rate, which discounts the future cash flows of all assets, if that goes up, equities in a lot of ways are just like a long duration security. It's just that the earning side of the coupon is variable rather than certain, the way it is in a bond. And so as interest rates rise, you get the price, downward pressure on the price of all assets. But then the other issue, which I think is important, is the literal supply elements. The fact that there's going to be a pickup in issuance means that somebody has to actually come through and buy the bonds. Now, governments never run into a problem where like no one's going to buy their bonds. Of course, people will buy, U.S. Treasuries, the most liquid asset in the world. The question is, at what price will they buy the Treasury? And do you need the yields to rise to induce people to come in? And secondarily, do you need people to sell other assets in order to finance the purchase of those bonds? And so that's really the dynamic that I think we're likely to see over the course of the next, say, 3 or 6 months, where that supply is going to have to be met in a way that's probably going to create a drag on other asset prices.
Yeah, makes sense. So if we look at this recession, do you think it's going to be quite a shallow one, or do you think it could be a little bit deeper? What are your, I guess, current thoughts on that? Or do we have to wait to see more data?
Well, what I'd say about the recession is my guess is it's going to be a lot more challenging than most people suspect. If you if you go look at surveys of asset managers these days, it's basically like 75% of them say there'll be a soft landing or whatever a no landing is. Okay, so that's like a no recession vibe right there. And then 25% are like hard landing. And then you're like, okay, hard landing. Talk to me about that. What does that mean for the unemployment rate? And they're like, well, I think it'll be like slightly above 4 from the current 3.5%. That is not a hard landing, right? That is not even a recession. That's a modest downtick in economic activity. And so I think what they're not recognizing is that in a typical macroeconomic cycle, it is a self-reinforcing dynamic, right? It's very, very hard to end a cycle that was driven by tightening in a way that doesn't cause a meaningful rise in unemployment. I'm talking like 5 or 6%, right? That is a typical cycle and that is way more substantive than what most people who are in the market today expect, but it's normal. And so I think even in people's view of hard landing, there is a lot of hope, unsubstantiated hope of sort of this like perfect shallow recession. And that's not going to happen because that's not the way these cycles work, because they are so self-reinforcing. And it's at a time when the Fed's tools to respond and stimulate the economy are not that good right now, right? I mean, we talked a year ago about how the Fed's going to have a hard time slowing down the economy. Okay, well, the flip side of that is the Fed can have a hard time stimulating the economy, right? It's the same basic mechanics. And then on top of that, what is typically a counter-cyclical mechanism, which is the federal government, in a typical cycle, starts spending as the economy is going down in order to offset the private sector. Well, the federal government has already running deficits that are wartime-like deficits. So are they going to be able to expand their deficits in a time of an economic contraction? Probably not as much as they would normally. And so you have constrained monetary and fiscal policy in an environment where you get that hard self-reinforcing dynamic. That's creating a situation where this recession might be much harder than most people are expecting.
Yeah, it's really interesting to think about. But I guess if I push back maybe on that employment perspective, because if you think about, I guess, the percentage change from 3 to 4.5, that's still quite a large change compared to maybe where we've previously been at 4.55, and that goes to 6. So I think you could maybe say that because we're at such a lower base, that percentage change could still be quite large and have quite a big impact on the economy.
It's pretty hard to arrest a recession when it gets going. I think that's even the shallow recessions of like the 2000 from recession from an employment perspective was still a very challenging environment, right? A still significant rise in the unemployment rate. And I think many people are talking about like probably the median expectation in the unlikely event that there's a recession, the median expectation is an under 100 basis points rise in the unemployment rate. And that's not how these cycles work.
And what would that do if we had that many people going out of work? I know we said recession, but I guess if you look at the overall economy, you can imagine that many people would have to, if they're locked into low interest rates, they might actually be forced out. There's, all this credit card debt. There's hardly any savings. Is this all adding up to having, very detrimental impacts on the economy?
I think the main question as an investor is connecting it to asset markets, right? And so what we're seeing equities, as an example, U.S. stocks that are pricing in a 12% earnings growth in 2024 relative to 2023. And I see that, and then I compare that to, in a typical recessionary environment, you get a contraction in earnings of something like 25 to 30%. Okay, well, that's a heck of a gap, right? We're seeing asset prices that are pricing in, continued growth when we might have a meaningful contraction. That gap between those two things, like if it's 50, it's 40 or 50%, 40%, like, that's a heck of an impact on asset prices relative to the current price levels. And that's not, that wouldn't be altogether that unusual. Like often, in a recession environment, you get earnings that compress 25%, and you get PEs that can fall 25 or 30% as risk aversion emerges, and that's how you get 50% declines in stocks. And to be clear, 50% decline in stocks, while it sounds like an extraordinary event, and certainly would be a surprise to many people, 50% declines in stocks happen in cycles. It's not a particular, it's not like a extraordinary move to have a 40 or 50% decline in the stock market. I mean, just think about it. Like, even a decline of that much, would probably, wouldn't bring us back anywhere close to where we were, say, prior to 2008 or something like that. So it's not like that's an extraordinary outcome. I'm just pulling up a chart here. Like, let's say, from today's S&P 500 level at 4,500, we went back and we said, let's say we went to 225, we'd be at 2016 levels in stocks, right? That's not 2016, 2017 levels in stocks. That's not a particularly extreme outcome. We could have a 40% decline, and we'd be looking at 20 pre-COVID levels of stock prices. Like, also, like, not, it wouldn't be like that extreme to see a situation where we have stock prices that are moving back to sort of pre-COVID levels around S&P 500 around 3,000. Wouldn't be like a totally extreme outcome.
Do you think that's, I know it's a possibility. Do you think it could happen? Because I feel like, I know we're saying it's not extreme, but a lot of people would probably freak out if that were to happen.
Yeah. Well, I think those people who might freak out are people who have not taken the long history chart of what happens to stocks through the cycles. Like, what I'm describing, while it sounds like very extreme, right? Like, if the S&P 500 is at 4,500 and you take 35% off of it, right, to go down to 3,000, it's just like not that big a deal in the scope, in the range of which stock prices move. Now, do I think at 3,000 the S&P 500 would offer pretty good value? Yeah, I think it would offer pretty good value, with PEs in the teens, relative to that, or given that price. Like, yeah, that probably is a pretty good value. But stock markets don't bottom when prices are, when someone looks at it and says that's expensive. Like, stock prices bottom when people look at them and say, wow, that's dirt cheap. That's when everyone's given up, that's when the equity market usually bottoms. And so to get levels like that through a recession environment is totally plausible.
So yeah, you throw out numbers. I guess, can you give us your base case? Not numbers specifically, but say in 6 months you think there could be a recession, and then S&P will have a drawdown of certain percentage. Is that sort of what
Yeah,
you're
well, I
saying?
think the way I'd actually think about this is, the economy, what is going to happen is that there's going to be a significant supply of assets into the economy, right? Sale of assets into the economy. And that's going to start to create and continued elevated, Fed tightening, right? And that's going to create a drag on all asset prices. And the question really is, how low do all asset prices have to go relative to where they are today to start to create a situation where you start to see some value in them? And that's where, what I'd say is, like, a balanced basket of assets, say like RPAR, the RPAR ETF, which is just the risk parity ETF, the all-weather style product that people can look at. I could easily see a circumstance where that falls 15% from where it is today, 15-20% from where it is today. I think the question is, how exactly does that work out, right? That could happen through the fact that the bond market falls a lot and stocks fall a little less, meaning interest rates rise a lot and the stock market falls less as a function of that. We could also have a situation actually where interest rates go down, right? That probably wouldn't be the first step I'd expect, but interest rates can go down and stocks can go down even a lot more. And so That's really, I think, the more sort of confident bet right now. I know that I'm not answering your question, but somewhat on purpose, because I, you know, I should say this, one of the beautiful things about financial markets is you don't have to trade a particular asset if you don't want to, in the particular form that it exists. You can pick whatever assets you want to trade, however you want to trade them, right? And so what I'm saying is like, no, I don't have a particularly, let's say over a 6 month time frame, 6 to 12 month time frame, I don't have a particularly strong view on stocks. I have a particularly strong view that assets need to go down in aggregate. I'm less confident about exactly what that mix is between stocks and bonds. And so being in a position to basically trade the package rather than the individual assets, I think makes a lot more sense. And that's where I'm talking about something like 15-ish% is probably where we need to go from here, given the current levels of valuation.
Okay, that makes sense. So when you say fixed income, does that mean that the price of it will go up and I guess the yields will go down, or are you sort of flipping it the other way?
Yeah, that's what I'm saying.
Yeah.
It could be, if you just think about like a balanced portfolio of stocks and long duration bonds that are risk matched to stocks, so like a TLT SPY combination of assets, like that package of assets needs to go down 15%, 15 to 20%, and so um, the solution to that could be they both go down 20%. You could have stocks go down 40% and actually bonds be flat or up, right? You could have bonds go down a more meaningful amount and stocks only go down a little bit because, whatever, inflation's higher than people expect. And so it goes more into the bond market than it does into the stock market. And the stock market benefits from the higher inflation. Some combination that looks like that, I think, is where you want to be positioned. And so that's why I say, because of the uncertainty about exactly how it flows through, better to be positioned sort of short both those assets on the long end. Stocks are essentially a long duration asset, as well as bonds, because you're probably that's got a better ratio trade. That's a better ratio trade than trying to pick which one you're talking about. And I think probably one way to think about this is the if you look at sort of the term premium of bonds, let's just think about that. Like, what's the world look like today? And the term premium of bonds, the reason why we look at that is that basically helps you understand the trade-off between holding cash and holding financial assets, because the risk-free long end risk-free rate exists in all financial assets because it discounts all cash flows. The term premium in bonds today, like, cash rates are in the fives and long end bonds are in the fours. And that's a pretty unattractive position to be holding long bonds relative to cash. And so what needs to happen in order for long bonds to look interesting relative to cash is you've got to have that term premium move up, say 75 basis points or 100 basis points, something like that, right? In order for you got to get 75 or 100 basis points more yield on assets relative to cash for assets to look attractive to hold relative to cash, right? If bond yields today were 5.25 or 5.5, you'd say that's not a bad bet right now, right? Not a bad asset to hold. Okay, well, what that means is if those have a 10 or 15-year duration and you move 100 basis points, you got to have a fall in price of 10, 15-ish%. And because the bond yield is really the discount rate for all assets, that discounting will exist in all assets. And so all assets will have to move down something like that 15%.
Yeah, it's really interesting. Thanks for explaining that, because I guess that's not a way that most people usually think
I
about
know.
markets. And yeah,
I'm sure. I'm sure it's not how the everyday person that you talk to thinks about how these things work. But anyway, that's the bonds are in the stocks. That's a very important thing to always remember. Bonds are in the stocks. Sometimes stock investors forget that bonds are in the stocks, but they are there no matter what.
yep, and it seems like a very important thing to remember. Uh, so I guess if this were all to occur, then we'd expect inflation to continue to go down, and then the Fed to potentially pivot once we see this. Is that sort of the way that you think it's going to go, or could there be the risk of higher inflation with energy increases and other aspects as well.
Yeah, I think the inflation picture is a little more challenging. Certainly it's more challenging than previous cycles that we've seen. Typically, if you go back to 2020 or '08 or even really 2000, like inflation wasn't really a worry. Um, and so, the Fed was basically able to prioritize growth relative to inflation and ease relatively aggressively when they saw the deterioration in growth conditions. The circumstances today are a little different. Now, of course, inflation has moderated from the peak that it was at, and there are signs that it might is maybe the good way to describe it, might be getting close to where the Fed's target is. But the real question is it durably there? And that really comes down to sort of two core inputs. The first is oil prices. Like inflation is driven by oil. It's kind of amazing, not quite as extreme as in the 70s, but still today, like, if oil prices go up from $3 a gallon or gas prices go up from $3 a gallon to $5 a gallon, there will be inflation, kind of no matter how you slice it. And, oil prices have been rising. It's not been nearly as extreme as right after the Russian invasion of Ukraine, but they're going up, and that is creating an inflationary impulse on the economy. I think the second thing is that determines sort of the structural inflation rate is how nominal wages are being set relative to the productivity of the employee. The point of which, or the mechanics of this, are relatively straightforward. They're relatively simple, which is basically like, think about how much growth there is in the nominal pay of someone on an hourly basis, and think about how much incrementally are they producing, what their productivity growth is on an hourly basis. And the difference between those two things is essentially what structural inflation is, because what it highlights is the difference between here's how much I'm increasing their pay versus here's how much they're increasing their output. And the difference between those has to be price. It just has to be resolved through price. And I think what we're seeing is there's still a pretty big gap there. Productivity is basically at zero in the U.S. It was that way a bit before COVID and has been that way after COVID. And nominal wage growth remains relatively elevated, 4, 5, 6%, depending on how you look at it. And in that environment, you're going to have that structural inflation pressure. And so I think you look at those things when you say, sure, measured inflation has improved. That's absolutely true. But what the Fed needs to see is they need to see inflation move durably to their mandate. And I think they've got some real questions about it. I mean, look, Chairman Powell at Jackson Hole was not, doing a tap dance saying the inflation problem's over. We've defeated it. It was actually transitory. All you fools who thought otherwise. Like he soberly described that there were still meaningful risks that inflation could be elevated for an extended period of time above the Fed's target. And that, is a reasonable reflection of the risks that exist and will drive the Fed to be more prudent and slower moving to ease than what they were in the '08 and 2000 cycles.
Yeah, and it could be the risk of them, they made the mistake in transitory. Maybe they'll make the mistake again in the other way.
Well, I mean, that is the nature of central banks. Central banks are, if they are following what they're supposed to be doing, they will make overshoot errors all the time. In fact, they're almost required by their mandates to overshoot, because what they need to do if they're doing their job as it's designed is they take in the information that they can see and they respond to the information that they can see. And then, of course, what if they're doing their job poorly, they're trying to predict because they can't predict. They're no good at predicting. That we leave that to the macro savants like ourselves to predict what's going on, right? The Fed doesn't really have that capability. And so they're just internalizing what's happening and responding to what's happening. But inevitably, that's missing. That means that they're not forward-looking, which means that they're always playing from behind. And you add in the lags of actually getting the data and then having to see a certain amount of trend in the data before making a decision. And they're handcuffed. They're handcuffed. They must operate essentially in a way where they're behind the curve all the time. Now, that is a problem because essentially they could be more effective in executing their monetary policy. So they create unnecessary swings relative to what would be optimal or ideal policy. But it's also a benefit for those of us trading markets, because you got to recognize, like, the Fed is a big critical actor in the economy, and they're always playing behind. And so they create, overshoots in one direction or the other. And that's fine, as long as you know that they're going to create overshoots, and you see that might not be priced into financial markets, then that gives you the opportunity for alpha. So, I like to call the Fed's the Fed being behind the curve. It's like a feature and a bug. It's a feature for those of us who trade markets, and it's a bug for making the best economic outcomes that could happen.
Yeah, that's an interesting way to look at it. And as you said, they always seem to make the wrong decision and acting too late. But no, it's interesting. So I guess will it just get to the point where after this recession, after this drawdown, it'll get to the point where these assets are at a good enough value that sort of the bottom comes in and then it saves that? Do you think there could be another catalyst that pushes us forward, or do you think it's really more just a tightening valuation issue?
Yeah, I mean, like, look, usually the way that this works is that asset prices fall, and then the central bank and the federal government eases, and at some point that easing, cuts the costs of borrowing and cuts the incremental costs of buying, goods, particularly big ticket items on credit, and that starts to reignite, starts to bring us to the upswing. I think the question here is, what is it going to take to create an upswing? The COVID period is a bit of an odd period for a variety of different reasons, and so I think it's a little challenging to really use that COVID period to understand what might go on in terms of the sensitivity of the economy to monetary and fiscal stimulation. I think the post financial crisis period at least gives a lens to say, well, it took quite a bit, right? I mean, really, the fiscal lever wasn't used at all until post-COVID, right? And then we started to take off. So, an environment where you're not getting much in the way of fiscal stimulation is certainly a concerning circumstance. Like, if you go back to the US in 2010, 11, 12, 13, where there's actually fiscal conservatism related to the post-financial crisis, Tea Party, et cetera, dynamics, like, that was a pretty bad time for economic activity and a very weak growth outcome versus previous, more V-shaped recoveries. And so, we're setting up, the dynamics are slightly different in this circumstance, but it is you can easily see a situation that is similar to that early 2010s period where the central bank, the Fed, is trying to ease and doing quantitative easing and cutting interest rates, and the federal government is kind of stuck given the deficits they're already running. You put those two things together, and it could be, instead of like a V-shaped recovery coming out of it, it could feel more like an L than a V in terms of the backside of this recessionary period.
Yeah, makes sense. So we've talked a lot about the US, but you mentioned Europe and UK before, and China. So I'm guessing that you think though they're probably at different stages of this, and I'm assuming they're going to act differently. Is that what you're thinking?
Yeah, well, I maybe start with China because it's really big. It's the world's second largest economy. And I think China is in a difficult circumstance where a lot of the drivers that have made them successful over the last 20 years are basically dried up. Like, what's the first thing that made them successful was, of course, moving hundreds of millions of people from farm to factory and becoming a massive exporter. That was very successful. Big deal. That's kind of that's in the past, not in the future. And then they tried to keep it going by extending a significant amount of credit and basically juicing their housing and real estate related markets, which kept growth strong. But they're starting to see the limitations of that. And now they're looking at a situation where they're unlikely to have sort of like an acute crisis the way a typical emerging market would have, because most of the debts are in their own currency and they can print the money or forgive the debts. That's not that big a deal. but the issue is basically like, are they in a position to do something? Like, what do they need to do to stimulate the economy? And I think that's a real question about whether the government, the Xi administration, is actually compelled to ease in the way that is necessary, or that would be plausible given the tools they have available. So far they haven't really done it. In the last couple of weeks, we started to see, like if you squint a little bit and you kind of turn your head to the side, you could say, maybe that's a little easing. 10 basis points here, $100 check to households there, better than nothing. But I think the real question is, it's a centrally run government, and the question is basically, is she gonna engage in the stimulation that's necessary? I don't know. There's better like political minds out there about China and the politics and all that stuff. I mostly just like look at what they're saying from a macroeconomic standpoint, and then just see whether it's a big deal or not. And so far, what they've been doing is a small deal. It's not enough. Maybe it'll be bigger. If it's bigger, then then we'll think about that. But it's not going to be a real source of strength in the global economy. So anyway, I've nannered on about China, but it's not looking good. And then I think actually I could be just a lot more concise about Europe and the UK, which is, look, they are in tightening cycles. Their inflation is too high. Their central banks have tightened. They're more fragile economies. You're seeing economic conditions slow down pretty meaningfully, particularly in continental Europe. You're seeing it slow down, but and you're seeing some weakness in UK employment as well. So maybe they're turning the page, and maybe they're starting to slow down. Starting to move into a weaker situation. But the problem is both of those countries have inflation that's too high, and central banks that really do need to keep at it to bring that down. Like people are being joyous about the fact that European inflation's at 5.5%, core inflation's at 5.5%. And it's like, okay, their mandate is 2. So like, we got a long way to go. And 6 months ago, inflation was 6. It's like, at this pace, we'll all be dead by the time the ECB gets, inflation back to their mandate. So they're going to have to keep at it. And the same is true of the UK. Like, wages are growing at 8%, nominal wages are growing 8%. Inflation remains extremely elevated. Core inflation remains extremely elevated. And you put that together, and that, the Bank of England has more to do. And so you basically have this situation where Europe, UK, US all need to continue to run tight monetary policy to slow down the inflationary pressures. And then the Chinese basically won't do what's necessary. They don't have an inflation problem, but they won't do what's necessary to reflate their economy. You put that all together, and that is a pretty unpleasant mix of conditions that we're staring at for the next, year and a half.
Yeah, it doesn't sound good. So Bob, thanks again for your
I
time.
hate to be the bearer of such bad news.
Yeah. Is there anything positive that you're looking at? I guess we've all talked about before we get to the end. Anything at all?
Anything at all?
Anything positive yet?
It's really not all that bad. Well, I think that the place where I do see some positive dynamics, depending on how you want to think about it, is the commodity complex has held in pretty well, given this overall tightening environment. And I think that speaks to the fact that commodity markets, after 15 years of underinvestment, are running quite tight, and that particularly the oil market was further exacerbated by the fact that the U.S. drew down the SPR in a way that is unlikely to be repeated anytime soon. And so you sort of put that together, and there's a possibility that, essentially on the long side, that like commodities look pretty good on the long side because they're pricing in pretty weak conditions already. There's the level of the prices is still pretty depressed. And there's these sort of structural factors that look a bit beneficial for commodities on a forward-looking basis. And so if you have to have, negatively correlated positions, long commodities look, about as good as any asset out there. The other thing that I'd highlight is gold, which, most people don't like to talk about gold, but in an environment where, main thing I like to say about gold is people forget that in 50% of equity drawdowns, gold is a better diversifying asset, performs better than bonds do. Yet everyone holds bonds and no one holds gold. And so this, we're coming into an environment where there might be downward pressure on stocks. And it is the type of environment where we might see gold continue to outperform. Now, like gold is up 40% relative to bonds over the course of the last few years since the Fed started tightening. So it's somewhat priced in, but there's no reason why gold couldn't extend its gains, particularly in an environment if the Fed is able to ease more aggressively and yields start to come down. You could see gold do very well in that sort of environment. So it's not all negative. There's some opportunities out there.
Yep. So, Bob, thanks so much for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
Oh gosh, well, I mean, I think the biggest thing is to recognize that that this cycle is probably this down cycle, right? Just in the same way the up cycle has been different than what most people expected. When you start to think about what a down cycle, a down move is in this economy, what that looks like, you should be prepared to think about it as being different than what you've experienced in the last, couple of decades. And in particular, I think the question that most investors need to wrestle with is what happens if growth is weak and bonds are not the diversifying asset relative to stocks? And that happens, and it happens in a lot of different environments. And what we've talked about is there's good fundamental reasons, tactical fundamental reasons why bonds may not be that support. And if you're sitting there in a 60-40 portfolio, that's a particularly scary circumstance that, now today is the time to start to prepare for a period, for the possibility that bonds are not the diversifying asset relative to stocks. And, there's steps that you could take, whether it's adding gold, whether it's adding commodities, looking for other assets, more defensively positioning in the equity market. There's a lot you can do, but just sort of gambling and saying, well, 60-40 has never failed me in 40 years is imprudent given the fact that this cycle is different than those cycles over the last couple of decades.
Great message segue. So, Bob, thanks again for your time. If anyone wanted to find out more about your work, where would the best places for that be?
Yeah, of course. I run a pretty lively macro related Twitter account at Bobby Unlimited, so definitely check that out if you're interested in the daily blow by blow about what's going on in the macro economy. Also, we didn't talk much about sort of my day job, which is running Unlimited, which creates index ETFs that seek to replicate the returns of 2 and 20 investment strategies to make those available to all investors. If that's the sort of thing that could be interesting for your portfolio, definitely check out unlimitedetfs.com.
Perfect. I'll put that in the description below, but thanks again for your time.
Awesome. Thanks so much for having me.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.